Hello, this is Alex with MasterChartsTrading.com, and this is market recap for Friday, October 30th, 2015. Today we'll look at stock market, which may be tapping out and definitely has slowed down as far as the gains are concerned. Market breadths have improved further, uh, but last week I showed a market breadth indicator that I created, and I showed it back to the 1990. This time around I actually got more data, and I'm going to show it back to the 1970, and we'll look at its predictive power in predicting the major trend changes. Bonds possibly have reversed. I don't know yet at this point. For now, I'm treating them as still as bullish. We'll look at bonds. Gold clearly fails at the initial test of the breakout, and GDX follows it lower. We'll look at one of the gold stocks, Goldcorp, which is down almost 20% from its recent highs. Also, lower prices in oil may have been rejected, and we'll see if it indeed is rejected, and multi-year lows in natural gas. And we'll see if this actually leads to a rally or not. All right, let's start out with S&P 500 ETF SPY, and it's a daily time frame going back 6 months. So clearly a very strong rally off this September lows. This is about 8% or so. We had what I thought was an exhaustion gap here last week, I believe. Now, some can say that this may be a breakaway gap. In other words, it breaks away here and continues higher. It's entirely possible. For now, I'm treating it as an exhaustion gap because this is a large move up, and this is a exhaustion of the move. Especially today on Friday, this large red candlestick completely engulfing the previous candlestick. So this could be considered a bearish engulfing pattern, but it needs to be confirmed with further weakness on Monday rather. Hasn't happened yet. So this is definitely a step in the right direction for bears. As far as market breadth is concerned, so new highs, new lows indicator has indeed hit plus 5%, so that's a positive sign. But if you look at some of the other indicators I follow, for example, MACD and ITBM, Breadth Momentum Oscillator, you can see that they're in a clearly overbought territory and look like they're about to roll over below their respective moving averages. And that's, so certainly not a good sign if you're a bear. We'll see where this leads, but for now I'm keeping a bearish bias simply because of this red line. The 50-day moving average is below this green line, the 200-day moving average. Now this may sound as a very simplistic model, but in the next few slides I will show that even this simplistic model is pretty good, but I will show that I have another indicator that I have created which actually improves this model significantly. Okay, let's take a look at the S&P 500, slightly longer time frame. This is an 11-month chart. So again, this is actual S&P 500, the actual index. So again, a pretty significant, powerful rally of the lows here in September. Possible bearish engulfing pattern here on Friday. Notice that the price is really close at the very end of the day. They're really close at the very bottom of the range. So there was quite a bit of selling continuing throughout, to the very last minute of the trading session, and that's not a very good sign for the pools. Also, this another momentum oscillator, a price momentum oscillator, you can see clearly in the positive overbought territory as well. Now, as far as market breadths, we have percentage of stocks above the 50-day exponential moving average and percentage of stocks above the 200-day exponential moving average. You notice that they both have moved above the 60% threshold. This one barely just moved above the 60% threshold and fell right back. So still, I mean, it's definitely a good sign. Also, bullish percent index, pretty powerful rebound. You can see here it was about, what is it, around 20% here in late August, and then continued higher. I mentioned here back in early August that this was an extremely oversold reading. All right, so let's next look at that indicator I said that I created, market breadth indicator going back to the 1970. All right, so this is S&P 500 large cap index in the lower frame here, going back all the way to the 1970s, 1970 here. Very long, long-term chart, and this is actually a daily chart. What I did is I removed the price of the index itself, and I only left the exponential moving average, so the 50-day and the 200-day exponential moving average. And we're going to say that, just for trading purposes, we're going to say that when the 50-day EMA is above the 200-day EMA, we're going to keep a bullish bias, and vice versa. When the red line, the 50-day EMA, is below the 200-day EMA, we're going to keep the bearish bias. And as you noticed, it works pretty good in many of the especially the recent time periods. But notice that here it's kind of hard to see, but it was like a whipsaw here. There was several. So those pink boxes here are whipsaws, because really the exponential moving average 50-day EMA moved below 200-day EMA, but truly the bear markets did not start. And here, vice versa, we had a bear market from the 71 till about 75, and then we had one whipsaw here, and the bull market did not start. Now, what I did is I created a custom market breadth indicator, and the way I read it is, first of all, it's composed of several market breadth indexes, together with several of the proprietary indexes, and momentum and trend indicators kind of rolled all into one. So the way I read it is, when this black line is below this red line, we're going to say that it confirmed a bear market. So here, red arrow down, and then this line actually went below this red line, so we did confirm a bear market. Here, the opposite happened. We had a blue line, blue arrow going up, and then we had confirmation of this a bull market beginning by a surge in this indicator above 4.5 all the way to 5. Now, pretty much this bull market continued unabated from 71 until 2000, except for one point here. This is where the indicator actually, I think, failed, but it failed in the favor of bulls. So this relatively small bear market, this is about 27% drop in the 81 to 80, what is it, 82, 83 years. So this is one failure of this indicator. Now, as far as the actual big moves, you can see that the blue and red arrows, this indicator called all of them. So if we're going to count this as one failure, because we failed to predict a bear market here, this was 1, 2, 3, 4, 5, 6, 7, 8, 9. So 8 out of 9 times, except for this one time, this indicator indeed called a major trend change. On top of this, what I like about this indicator is that it actually eliminated many of the whipsaws. So many of those pink boxes, they show that even though here in I believe this is a Black Friday, this was a major drop here, and I think like 20% in one day. But truly, it was a kind of like a one-off event and 20% drop, but then afterwards the market quickly recovered and continued. Notice that this indicator actually did not call for a bear market. The bear markets did get confirmed in I believe in 71 here, clearly got confirmed here in 2000, in the year 2001, I think, and then next time 2008. And vice versa, the bull markets were also very well confirmed here in 83, and then also here in 2003 was a clear confirmation, and then again in 2009 here. Now, what I'm getting right now in 2015, in September, October of this year, is I'm getting a bearish signal right now. So I have 8 out of 9 success rate. That's 89% success rate for this indicator. And one time when it failed, it actually failed to call the bear market. The bear markets were called 100, well, so far 3 times out of 3. So for now, I'm going to trust this indicator, and I'm going to say that this is indeed correct, and I will say that I will keep my bearish outlook on the stock market, and I will continue to look for shorting opportunities. All right, next let's look at bonds. AGG, iShares Barclay Aggregate Bond Fund. This is a diversified bond fund that holds various types of bonds. So we had a pretty nasty gap here on Thursday and then continued lower. I'm not sure what to make out of this. Definitely a well, somewhat bad sign if you're a bond bull like me. But then Friday we already had a very strong rebound here. So this looks like a nice white candlestick, and it looks like we're attempting at the very least to fill this gap here. Not sure what to make of it, but you know, if stocks roll over here, bonds are surely going to benefit. And yeah, anyways, actually another one is, look at this on balance volume indicator. You know, it's a very large volume traded today, 10 million shares. You can see that the on balance volume actually is broken out, has broken out above this level here. So could this be a leading indicator? It's entirely possible. For now, I'm keeping a bullish outlook on bonds, and if they, sell off anymore, I might consider actually buying and adding to my holdings. Next, let's look at gold spot price daily chart. So several weeks ago, I pointed out this potential breakout in gold. Gold broke above this resistance level and actually closed above the 200-day moving average. Now, a very similar, it's kind of hard to see, but a very similar thing happened here. It broke above the 200-day moving average, stayed there for a couple of days and just collapsed afterwards. We're certainly getting something very similar. So there's this saying, early bird gets the worm, but there's also a saying that second mouse gets the cheese. And you can see a breakout, and I was really waiting for a retest of this breakout. And this is a resistance level that became support, or should have become support, and it clearly failed. If this was a support level, then it clearly failed it. It landed right now at this minor support level around 1140 and this 50-day moving average. So there is some support here. So I expect at the very least a minor rebound. But since this is a bearish security, I don't consider. I'm looking for basically overbought conditions within a bigger downtrend rather. So yeah, basically it's still bearish, and it might continue down at the very least here. It's entirely possible we'll take out these lows as well and go to new multi-year lows. I'm not sure how we're gonna get there. We may do kind of like several bounces, and actually this is a very logical place for at least a temporary bounce. But if we fail here at the 50, then this 1103 or even 1097 area would be the next place to look. All right, let's look at GDX, Gold Miners Market Vectors Gold Miners ETF. Clearly a bearish security as well. You know, gold from this point, let me just go back. From this point to today, this is about 4.5% move, and then going back to GDX, this is about, I think this is 14. Let me just do a quick rollover, and this is about 12.5% move here for the GDX. So it's pretty powerful breakdown. Not yet at the 50-day moving average, so possibly we will get, maybe it will make a stand here at 1450 and then try to rebound. Alternatively, if the dollar, especially if the dollar strengthens any more, we could get another retest of the $13 area. Notice there's quite a bit of support here in the $13 area, but who knows, maybe we'll break that support. As far as market breadth for gold miners, let me just update this. Maybe we'll get a new reading. No, not yet. So, anyways, I think the advanced decline lines and advanced decline volume lines are sort of trending downward, while price sort of was trending upward. So this was a bearish divergence. I pointed this out several weeks ago. Now I think also we're getting a breakdown in unbalanced volume. You can see it's kind of breaking below this trend, this upslope and trend line. So there's possibly quite a bit of volume behind this move, 42 million shares, so that's quite a bit. Also, bullish percent indexes seem to be rolling over here. And you know, momentum indicators are of course rolling over as well. Now, one of the stacks within it, this is a GDX is a you know, also sort of a top heavy fund. So top 10% of the holdings are in 54% represent top 10 of the holdings. And one of the stocks here, Goldcorp, especially caught my interest. So let's look at Goldcorp next. Goldcorp signal symbol GG. You can see kind of similar consolidation to GDX here, and then just a nasty, you know, a gap down and a breakdown. And this was actually reports. It was earnings report. That was apparently a badly missed earnings report. This is about 20% move in Goldcorp. So you know, once again, I'm bearish on gold and GDX and gold miners by extension. All right, next look at light crude oil, WTIC. So I still think that oil is in a bear market, and this whole setup, I mean, it kind of looks like a bull flag. With this is a handle of a flag, and this whole thing is kind of like a flag consolidation. But alternatively, you can see that this price was rejected here, the 200-day moving average, and we moved down sharply. Now, again, here on the bottom, price was rejected at the bottom as well. So this breakdown below 43.21 so far failed with a pretty powerful day here, a big white candlestick. Where will this lead? It's very difficult to say. My bias is bearish, so I would be more interested in bearish setups than trying to pick the bottom. That's pretty much it, all I wanted to say about oil. Let's look at natural gas real quickly. Natural gas spot price daily chart. Big nasty breakdown here. Two multi-year lows. I think this is a 6-year low. And this could be a bottoming candle here. There's a very large buying tail at the bottom and a large engulfing white candle. So maybe this is an outside reversal. We can see that this red candle is within this entire range of the white candle. This could be an outside reversal. I haven't, you know, basically the same thing is we could rally very easily to the 50-day moving average. So from here to here, but it's really difficult to try to find the bottom in the downtrending security, and this is still very much a downtrending security. 52-week lows, 6-year lows are very bearish, and following a rebound, most likely we will see more selling unless something happens, and I don't know, there is just oversupply of gas, and for some reason the supply of gas tightens. So for now, natural gas still bearish. All right, next, let me show you quickly how to find us on the internet. Please go to MasterChartsTrading.com. We do have a trade alert service that is now live, and I'm getting some pretty good feedback from subscribers. So please sign up for our trade alert service. We have a 3-week trial period, so pretty much no cost, a free trial period to begin with. If you have, obviously this information will be posted on the blog and the video section. Also, the public charts and social page lists our information of where to find us on the public chart page. Most of the charts you're seeing here will be posted there as well. If you have Twitter, Facebook, YouTube, or StockTwits account, please find us there. If you have, also you can sign up for our mailing list. That's it for this week's recap. Thanks for watching and have another great trading week. Bye bye.